Hello, everyone, and welcome to BFW 2401, Week 3, Loan Sales and Securitization. Now, this part, I choose to divide it into two parts. The first part is, we'll talk about loan sales, and the second, which is around 20 slides, and the second part is the securitization, which is around 26 slides. Now, loan sales and securitizations is actually one of the most recent practices in finance used for financing and refinancing. And it was highly used and implemented during the global financial crisis and was actually one of the tools that was blamed for the causes of the financial crisis. Now, without going further in this issue, I will discuss it in the slides. Allow me now to share my slides and go straight to the lecture. So this is actually what we are talking about. This is the loan sales and securitization. And this is the part one. So this is actually our map. And you remember we talked in week 2 about interest rate risk. So I choose to bring loan sales and securitization as one of the tools of the risk management, which is to manage interest rate risk. So if we are talking about loan sales and securitization, and in the context of BFW 2401, we are talking about it in terms of managing the risk, not actually as a tool for financing or refinancing, but as a tool to manage the interest rate risk, as I'm going to explain it. I think this slide will give us more picture about what we are talking about, or clearer picture of what we are talking about. This is, for example, if I have this balance sheet, which is before the securitization or the loan sales. And as you can see, the loans, I have 90. And when we talk about loans that equal to 90, it's actually in my banking book. And when I talk about my banking book, it's those assets that I will keep till maturity. So if this is a loan sales, if it is loans for mortgages, for example, housing loans, that will stay for 20 years in my balance sheet. But securitization and loan sales will allow me to sell them today and replace them, or use the money use the proceeds for some other issues. So now if I sell 20 of this, my balance sheet will look after the sale like this. So instead of 90 loans, now I have only 70. And I used to have a cash of 5. Now I have a cash of 25, which is the original 5 plus the 20. Now this 20, I can use it to solve my liquidity problems. If I am under liquidity stress, I can also pay it back to depositors if I want to decrease my reserve. By selling these loans, actually I'm taking this loan with all its problems out of the balance sheet, including the credit risk. But this is actually the process. But the most important thing is actually the interest rate risk. Now, let me go first now to the learning objective. So the learning objective, we want to discover why we sell loans. Actually, we sell loans for so many reasons, and I explained that. But the main one is to manage our interest rate risk. So this is the first part, which I will talk in this part, which is the 20 slides. And this is actually, I will talk about it in the second part, which is the securitization. As I told you, securitization and securitization and loan sales almost the same. If you look at them from the perspective of moving the loans from my balance sheet, is just the way we do it is differently. And having said that, if you look at my agenda, after the introduction, we'll talk about loan sales. And then the second part, we talk about securitization, and we'll finalize and summarize this lecture. look at the interest rate risk and managing it through securitization. Now, assume you have this position. You have risk-sensitive assets of 10 and risk-sensitive liabilities of 10. Now, think about the repricing model. The repricing model will tell me to calculate first the gap, and then multiply the gap by the changes in the interest rate to get the impact on the net interest income. Now, this one, I have a zero gap, and I am neutral, very neutral now, which is actually, let me take this out, and let me take this out and this out. So this is the position I have now, and I want to, trying to not to be impacted by the changes in the interest rate. In the future, I don't have enough expertise to see or forecast the movement of the interest rate. But if I have the forecasting capabilities and the expertise to know the movement of the interest rate, and I want to take advantage of this. Now, if the interest rate is going up, I need to have a positive gap, which means I have to have my assets more than my liabilities. And therefore, I will take this position, which is position number 1. If the interest rate is going down, which is what I will do now, I will buy 5 of loans, and now my asset will be 15, my liabilities will be 10, then I will be 5 plus, and that will be a perfect position for me if the interest rate is increasing. Now, if the interest rate is going down and I still want to impact positively my net interest income, I need to have this gap to be minus, right? So if this is going to happen, I need to sell 5 of those and come back to, and go back to case 3, where I have only 5, and then I have 10 here. So I have a positive gap, a negative gap. If you multiply the negative gap by the decrease, which is negative in the interest rate, this is a perfect position for me. And overall, this is how we use the interest, the loan sales and securitization to manage the interest rate risk. Having said that, let me move to the introduction back. And we say now, in addition to loan sales and securitizations, of course, we use those, what we call the financial derivative contracts, like forwards, options, and the swaps, and we use loan sales as management tools. Now, these loans as a securitization has been a very, been in existence, as I mentioned, during the financial crisis, but extensively used by the American banks, Australian banks. However, there is something called the homogeneity of the loans, which means you need to have, if you are going to go for loan sales, that's fine. You can sell any loans, individual loans or a group of loans. But if you are going to go for securitization, which means you need a package of loans that have the same maturity, the same risk, and the same rate of return. You can back them now and produce a bond. And that bond, you can sell it inside the country or outside the country. That process is called securitization. In this process now, we talk about only loan sales. But to give you an information here, actually the American banks can sell retail loans. Now, when we say retail loans, we can talk about housing loans, car loans, sometimes credit cards if you have, but actually you want, as I told you, homogeneous loans. So you need type of loans. For example, you can take the car loans that are for 5 years, that give 6% rate, and they are the same risk. You can do this for housing loans. This has been a practice in Malaysia, but and so many countries also practice, and mainly in the US and on Australia. Of course, I will explain to you later on now when we talk about the trends, how this industry of securitization is actually picking up. Now, this is actually some trends. And you can see this is the Australian, this is 2011, but I get also, I managed to obtain new recent data. Just to give you an example here, this is the financial crisis. And this is why I told you they blamed the securitization because they were backing the subprime loans. And the subprime loans is actually the loans that are bad. They actually make some type of insurance for it. But then when there was so many defaulting insurance, even the insurance company like EIG was defaulted. Anyway, what I want to say is that the hike, the big securitization issues actually was in Australia here, was during the financial crisis. Same thing in the US, as you can see, up to 2009, 2007 was the top. And you can see the blue lines means it's a normal practice by banks to do it. The gray color here means only companies who are, or banks who are under distress, which makes sense. If you are under distress, either liquidity stress, whatever, you tend to sell loans or make securitization to, to get cash and manage your problems. But as you can see, it wasn't like that. In the US, it was a normal practice. They issue the loans, they do it, they collect the fees, they sell it for somebody else, and they go. Malaysia was also doing the same thing. They have something called, they have a party supervised by the Bank Negara called Kagamas. They buy the loans from those banks and they sell them as bonds or sukuk. Sukuk is the Islamic, what's called bond, Islamic bond. But they can sell it also as bonds. And the purpose of the government pushing, any government pushing for securitization is because if they want to stimulate the economy, because when banks consume all of their resources, all of their cash and deposits, they don't have any more to give more loans. Securitization and loan sales will allow them to sell the ones they have now to investors and other people who collect it. They can sell this cash flow in the future, get the cash, make a new loans. This is good for them, and also this good for the economy because you will give more loans. For example, if you give housing loans, the housing sector will move the whole economy. It will stimulate the whole economy. So when you have a credit in the market and you have liquidity in the market, the economy will be stimulated, especially when you have during crisis times. This is data, international data, and don't worry about all those numbers and all these names. These are the names of the vehicles. They have EPS, CMBS, CLO, different names. They have so many different names. But as you can see, Australia is just from 12 to 15. This is up to 2018. But the big one, we are talking about billions. So the US is coming to the top. The Europeans, they have long history of securitization, but actually the Chinese are picking up, and they are picking up strongly in their securitization. This is a recent data. I get it from this article, and this is the link, and they can add it to your resources. As you can see, this is 2008. After 2008, it was dropping, but now they are picking up, especially in 2020. This is some arrangement between the Americans and the Chinese to issue more securities, and the Chinese will buy for these housing loans, for those securities, backed securities by loans in the US. And this is why it is very high also here, but it is actually picking up also in some other countries, like 2010 goes down and then it goes up. This is the Europe. If you want to look at this, I think I have the article, and I give you the link. This is the article I have. You can look at it. They talk about it's very, a short one. You're not going to spend a long time. From a consultant in India, they talk about the US. They talk about China, Europe, China, and also India. If you have time, you can look at this. It's very interesting, I know. But anyways, whether we are talking about this slide or this slide or this slide, all these trends, you are not responsible about it in the exam. Is just for the sake of understanding. Now let me move a little bit to the real issue of this part of the lecture, which is type of loans. We have two arrangements when we sell the loan, and I want you to look at them. One of them called participation, and the other one is assignment. Now, to give it in a very simple word, when you sell a loan and you agree, you are the originator. Originators means, for example, public bank, generate that loan or made that loan, a housing loan of 1 million ringgit. Then they want to sell that loan. They can sell it to a buyer, but if the borrower who is taking that loan default and didn't pay, because they will sell the cash flow, right? The future cash flow and the interest of this loan to somebody else, collect the money now and bring it to cash to the bank and take the loan out of their balance sheet. Now, participation saying this arrangement, this type of contract will tell you buy the loan, and if there is any problem, give it back to me. I mean, if the borrower is not paying, I still responsible about the credit risk. So this one, they say it participation, or the other term, which we will talk about it, called sell with recourse. Sell with recourse means participation, which means the credit risk is still the responsibility of the originator. Now, the assignment is different. It is the same process of selling, but however, the credit risk will be the buyer responsibility. Of course, they will sell the loan cheaper. And in this case, whatever happened to that loan, that borrower, if they don't pay, you don't come back to the originator, it will be your problem as a buyer. Of course, the assumption is that the loans are in an acceptable quality, and the originator originate, reasonable loans. They don't do, any type of, they are not actually making bad loans for the sake of selling them later on. So that, ethical issue is not there. And and this is the assumption. So assignment is actually you sell the loan, and it will be the business of the buyer to take care of that one, of any credit risk. Now, why we sell loans? We already talked about the interest rate risk, but also there are some other things. We can do credit risk management. When we say credit risk management, see, when you move the loan from your balance sheet, actually you move the loan with all of its problems. If that problem is bringing, if that loan is bringing liquidity risk, it's out. If you are bringing, any capital obligation, which means you have to increase your capital because you are increasing your loans or your assets, when you take the loans, that capital, requirement will decrease. They do it for fee income. They do it for reserve requirements. Let me just, the credit risk management is very clear because you sell the loan, and when you sell the loan, especially when you sell it with assignment, that credit risk of all those assets is gone for the loans you sell. Now, also, reserve requirement. What is reserve requirement? In this country, like any other countries, in Malaysia, the requirement, if you receive $1 as a deposit, you have to put 4 cents or 4% of that in the central bank as a reserve. Now, all those central banks will do this to manage the supply of money and to be sure that there is a collapse or whatever, they have some reserve, to protect the customers. So if you sell your loans, if you have 100 billion of loans and you sell 20 billion of them, or make securitization or securitize 20 billion of them, which is 20%, and you manage to get back this money to the depositors, actually you have now only deposits of 80. And in this case, I mean, you decrease the deposit by 80, and then of course you will withdraw that or decrease that reserve requirements in the central bank. The fee income is a big issue now, and actually huge banks are doing. They don't do even underwriting. Underwriting means when they issue for underwriting was giving a lot of money to the banks because they what they do is they issue IPOs and they buy all those new IPOs for companies and they sell in the market and they take the difference. Now with fee income, with securitization, actually they are collecting income and not being responsible about the loan. In other words, if one of CIMB today promise those customers or promise the market that they will issue 500 loans, housing loans by 2022, assuming that the economy will be booming by that time. So this is 500 million. And they organize and they make some arrangements with Kagamas, which is this the buyer of those loans or any other buyer, to sell them the loan at the same time. So actually the buyer of those loans will take the interest and the principal. So what is the use for the bank? The bank will collect a lot of fees, which means they make loans of 500 million. They give it to the customer. They receive it maybe in the same week from the buyer. But in the same time, when they issue those loans, they collect a lot of upfront fees for making these loans. And if you go to any bank and you make a contract, there is always fees other than the interest for issuing that loans. Specifically when we talk about housing loans and big business loans and all these things. The other thing is the capital cost. Now the capital cost is actually you are decreasing the capital is connected to the total assets. According to the Basel requirement, you have to keep 10.5% of your total assets as capital, and capital is very expensive. You have to, raise what we call common equity capital, tier 1, tier 2, all this type of capital. Now, when you issue more loans, you have to have more capital. So if you decrease actually the loans by selling them, your capital requirements, if you have 100 billion of loans of total assets, and you sell 50% of them, which means now you are paying, and you used to pay 10.5 billion of those as capital or keep as capital. Now you only keep 10.5% of the 50 billion, or which is actually 50% of what you used to have. And this is a huge decrease. Capital is very expensive to raise and to maintain, okay? Then we have liquidity risk. Liquidity risk is actually very direct. You just replace very illiquid assets, which is the loans, with a very, very liquid assets like cash. So actually you are solving any liquidity problems if you are under stress of any liquidity, and you can solve your problems. Now to talk about these issues, these boxes, already reflected in the following, this slide is reflected actually, if you want to read about it here, and we are done with this here. Now, let me go to the calculation. Calculation is a very simple issue when we talk about loan sales. See, if you are now in a bank and you are making these, if two banks are making negotiations and you are one of the teams for any of those banks, involved in this negotiation, what you are going to talk about is if you are selling a loan, the most important thing you will talk about it is what type of loan, what type of arrangement, is it assignment or participation? And the second thing, which is the most important item in the contract, is how much. So how much is a very simple what we call cash flow issue, and time value of money problem, which means you are selling the cash flow, the future cash flow of the interest and the principal, and you want them to get the principal. So if you have a loan, for example, here, if you have a loan of 10 years, 10 million, that is paying 8%, and you want to sell this loan today. If you want to present this, for example, in this graph, just to remind you of the cash flow. So this is time 0, for example, and this is year 1, this is year 2, and this is year 3. And you are going to receive 80 here in year 1, and you are going to receive 80, which is the interest, and you are going to receive your principal plus the 80 in the 3rd year. So all you want to do, you want to see how much is, you want to bring those type of cash flows to time 0, which is the present value. You want to calculate actually the present value, which is the price of the loan. This is the problems of the loan. It's a cash flow of this 3, what we call annuities. We have annuities and we have single amount. If you look at the problem here, you have, see, this is the annuities. This is the 800 million, which is the interest for 3 years, plus the 10 million discounted. And this is actually the price of the loan that the buyer has to pay to the seller now to get this future cash flow. Now, there is something called selling with recourse. I remind you now, selling with recourse or selling without recourse. This is participation, and this is assignment arrangements. Of course, when we talk about participations, means the originator still responsible about the credit risk, and therefore they will sell the loan cheaper, more expensive. They will sell the loan more expensive because they will be responsible about the credit risk. So the originator will be responsible about the credit risk, and therefore they will sell the loan more expensive, which means they are using 8.5. Here, the arrangement, if you sell with recourse, is 8.5%. So you discount. So this is the return that actually the buyer will get, 8.5. So he has to pay like this. But if the buyer is willing to go with assignment, and most of the time of the sellings is actually assignment, and they sell it without recourse, which means the originator has nothing to do with any future credit risk, then they will get it cheaper, and they will ask maybe for 25 basis point more. So this is 8.5, this is 8.75%, and in this case, you discount the same thing and you find it here. So actually, they are getting it here cheaper than this way, because the buyer will be responsible about the credit risk. That's all for today, for this first part, and I will see you in the second part of this recording. Thank you very much, and let me stop sharing. I will see you in the second part. Thank you very much, and bye-bye.